Chapter 14 Time Cycles. The longer a trend line or a support or resistance level remains in effect, the more valid it becomes. Many of the eyes of seemingly unrelated phenomena clustered around similar periods. The cycle bottoms are called troughs and the tops referred to as crests. Notice that the two waves shown here are measured from trough to trough. Cyclic analysts prefer to measure cycle lengths from low to low. Measurements can be taken between crests, but they are not considered to be as stable or reliable as those taken between the troughs. Therefore, common practice is to measure the beginning and end of a cyclic wave at a low point, as shown in this example. The three qualities of a cycle are amplitude, period, and phase. Amplitude measures the height of the wave as shown in figure 14.5, and is expressed in dollars, cents, or points. The period of a wave, as shown in figure 14.6, is the time between troughs. In this example, the period is 20 days. The phase is a measure of the time location of a wave trough. Phasing is also used to identify the date of the last cycle low. Assuming the cycle remains fairly constant, it can then be used to estimate future peaks and trough. That is the basis of the cyclic approach in its simplest form. Fig. The cycle of a price, a supple single price war of the kind that combines to form The cycle bottoms are called troughs and the tops referred to as crests. Notice that the two waves shown here are measured from trough to trough. Cyclic analysts prefer to measure cycle lengths from low to low. Measurements can be taken between crests, but they are not considered to be as stable or reliable as those taken between the troughs. Therefore, common practice is to measure the beginning and end of a cyclic wave at a low point, as shown in this example. The three qualities of a cycle are amplitude, period, and phase. Amplitude measures the height of the wave as shown in figure 14.5, and is expressed in dollars, cents, or points. The period of a wave, as shown in figure 14.6, is the time between troughs. In this example, the period is 20 days. The phase is a measure of the time location of a wave trough. Phasing is also used to identify the date of the last cycle low. Assuming the cycle remains fairly constant, it can then be used to estimate future peaks and trough. That is the basis of the cyclic approach in its simplest form. Fig. The cycle of a price, a supple single price war of the kind that combines to form stock and commodity price action. Only two cycles of this wave are shown, but the wave itself extends infinitely far to the left and to the right. Such waves repeat themselves cycle after cycle. As a result, once the wave is identified, its value can be determined at any past or future time. It is this characteristic of waves that provides a degree of predictability for equity price action. Fig. The amplitude of a wave in this figure, the wave has an amplitude of $10 from -$5 to +$5. Amplitude is always measured from wave trough to wave crest. Fig. The period of a wave. In this figure, the wave has a period of 20 days, which is shown The period of a wave. In this figure, the wave has a period of 20 days, which is shown measured between two consecutive wave troughs. The period could just as well have been measured between wave crests. But in the case of price waves, the wave troughs are usually more clearly defined than the wave crests for reasons that will be discussed later. Consequently, price wave periods are most often measured from trough to trough. Fig. The phase difference between two waves. The phase difference between the two waves shown is 6 days. This phase difference is measured between the trough of the two waves because, again, wave trough are the most convenient points to identify in the case of price waves. Cyclic principles. The four most important ones are the principles of summation, harmonicity, synchronicity, and proportionality. The principle of summation holds that all price movement is the simple addition of all active cycles. Cycle theory holds that all price patterns are formed by the interaction of two or more different cycles. The principle of summation gives us an important insight into the rationale of cyclic forecasting. Let's assume that all price action is just the sum of different cycle lengths. Fig. The summation of Fig. The summation of two waves. The dotted lines show how, at each point in time, the value of wave A is added to the value of water B to produce the value of composite wave C. The principle of harmonicity simply means that neighboring waves are usually related by a small, whole number. That number The principle of harmonicity simply means that neighboring waves are usually related by a small, whole number. That number is usually 2. For example, if a 20-day cycle exists, the next shorter cycle will usually be half its length, or 10 days. Cycles with longer periods, lengths, should have proportionally wider amplitudes. The amplitude, or height, of a 40-day cycle, for example, should be about double that of a 20-day cycle. The principle of normality is based on the premise that, despite the differences that exist in the various markets and allowing for some variation in the implementing of cyclic principles, there seems to be a nominal set of harmonically related cycles that affect all markets. The model begins with an 18-year cycle and proceeds to catch successively lower cycle half its length. The only exception is the relationship between 54 and 18 months, which is a third instead of a whole. When we discuss the various cycle lengths in the individual markets, we'll see that this nominal model does account for most cyclic activity. For now, look at the days column. Notice 40, 20, 10, and 5 days. You'll recognize immediately that these numbers account for most of the popular moving average lengths. Fig. You'll recognize immediately The principle of normality is based on the premise that, despite the differences that exist in the various markets and allowing for some variation in the implementing of cyclic principles, there seems to be a nominal set of harmonically related cycles that affect all markets. The model begins with an 18-year cycle and proceeds to catch successively lower cycle half its length. The only exception is the relationship between 54 and 18 months, which is a third instead of a whole. When we discuss the various cycle lengths in the individual markets, we'll see that this nominal model does account for most cyclic activity. For now, look at the days column. Notice 40, 20, 10, and 5 days. You'll recognize immediately that these numbers account for most of the popular moving average lengths. Fig. The simplified nominal model. How cyclic concepts help explain charting techniques. Standard charting techniques, trendlines and channels, chart patterns, and moving averages can be better understood and used to greater advantage when coordinated with cyclic principles. Notice how much the horizontal cycle along the bottom of the chart resembles an oscillator. Fig. Channel formation. Notice how much the channel formation. Source. Fig. Adding another component. Source. Hurst, J.M., The Profit Magic of Stock Transaction Timing, Englewood Cliffs, N.J. Prentice Hall, Inc. 1970. Fig. Fig. The Summation Principle Applied. Source, Hurst, J.M., The Profit Magic of Stock Transaction Timing, Englewood Cliffs, N.J. Prentice Hall, Inc. 19007. Dominant cycles. Dominant cycles are those that consistently affect prices and that can be clearly identified. The proper procedure is to begin the analysis with a study of long-term dominant cycles, which can span several years, then work toward the intermediate, which can be several weeks to several months. Finally, the very short-term cycles, from several hours to several days, can be used for timing of entry and exit points and to help confirm the turning points of the longer cycles. Classification of cycles. The general category. Classification of cycles. The general categories are long-term cycles, 2 or more years in length, the seasonal cycle, 1 year, the primary or intermediate cycle, 9 to 26 weeks, and the trading cycle, 4 weeks. The trading cycle breaks down into 2 shorter alpha and beta cycles, which average 2 weeks each. The labels primary, trading, alpha, and beta are used by Walt Presser to describe the various cycle lengths. The Kondrativ wave. There are even longer range cycles at work. Perhaps the best known is the approximate 54-year Kondrativ cycle. This controversial long cycle of economic activity, first discovered by a Russian economist in the 1920s by the name of Nikolai D. Kondrativ. In particular, a 54-year cycle has been identified in interest rates, copper, cotton, wheat, stocks, and wholesale. Fig. Kondrativ long wave. For more information, see The Long Wave Cycle by Nikolai Kondrativ, translated by Guy Daniels, New York, Richardson and Snyder, 1984. That translation is the first ever from the original Russian text. Copyright 1984 by the New York Times Company. Reprinted by permission, May 27, 1984 p. F11. D. Combining cycle lengths. As a general rule, long-term and seasonal cycles determine the major trend of a market. Obviously, if a 2-year cycle has bottomed, it can be expected to advance for at least a year, measured from its trough to its crest. Therefore, the long-term cycle exerts major influence on market direction. Markets also have annual seasonal patterns, meaning that they tend to peak or trough at certain times of the year. Grain markets, for example, usually hit their low point around harvest time and rally from there. Seasonal moves usually last for several months. The 3 to 6 month primary cycle is the equivalent of the intermediate trend. The next shorter cycle, the 4-week trading cycle, is used to establish entry and exit points in the direction of the primary trend. If the primary trend is up, troughs in the trading cycle are used for patiences. If the primary trend is down, crests in the trading cycles should be sold short. The importance of trend. The trend of each cycle is determined by the direction of its next longer cycle. Once the trend of a longer cycle is established, the trend of the next shorter cycle is known. The 28-day trading cycle in commodities. There is one important short-term cycle that tends to influence most commodity markets, the 28-day trading cycle. In other words, most markets have a tendency to form a trading cycle low every 4 weeks. One possible explanation for this strong cyclic tendency throughout all commodity markets is the lunar cycle. Left and right. Translation. The concept of translation may very well be the most useful aspect of cycle analysis. Left and right translation refers to the shifting of the cycle peaks either to the left or the right of the ideal cycle midpoint. For example, a 20-day trading cycle is measured from low to low. The ideal peak should occur 10 days into the cycle, or at the halfway point. That would allow for a 10-day advance followed by a 10-day decline. Ideal cycle peaks, however, rarely occur. Most variations in cycles occur at the peak or crests and not at the trough. That's why cycle troughs are considered more reliable and are used to measure cycle lengths. How to isolate cycles? In order to study the various cycles affecting any given market, it is necessary to first isolate each dominant cycle. Periods between those cyclic tops and bottoms, certain average lengths can be found. There are tools available to make that task a bit easier. One such tool is the Cyclic Cycle Finder. An electronic version of that device, called the Cyclic Cycle Forecaster, is now available as an analysis technique on Omega Research's TradingStation and Super Charts. #Omega Research, 8700 West Flagler Street, Suite 250, Miami, FL 33174. 305, 5,519,991. Fig. Example of left and right translation. Figure A shows a simple cycle. Fig. Example of left and right translation. Fig. Example of left and right translation. Figure A shows a simple cycle. Figure B shows the trend of the larger cycle. Figure C shows the combined effect. When the longer trend is up, the mid-peak shifts to the right. When the longer trend is down, the mid-peak shifts to the left. Right translation is bullish, left translation is bearish. Source: The Power of Oscillator, Cycle Combination by Walt Pressert. Fig. The four-year presidential cycle is clearly identified with the Cyclic Cycle Forecaster. See vertical lines. If the cycle is still working, the next major low would be expected to occur during 1998. Fig. The Cyclic Cycle Forecaster has identified a 49-day trading cycle in S&P 500 futures prices. See vertical lines. Fig. The Cyclic Cycle Forecaster has identified a 49-day trading cycle in S&P 500 futures prices. See vertical lines. The ECF estimates that the next cycle low will be formed 49 days from the last cycle low, which would be on March 30, 1998. Fig. Fig. The ECF has uncovered a 133-day cycle in Boeing. See vertical lines. Since the last cycle low occurred during November 1997, the ECF estimates that the next cycle low is due to occur 133 days later on June 3, 1998. Fig. The bottom in the cycle Aries coincide with important reaction lows in the Dow when spaced 40 weeks apart. That suggests a 40-week cycle in the Dow. The last two cycle troughs were in the spring of 1997 and the start of 1998. See arrows. Fig. The daily cycle RS revealed the presence of 50-day cycle bottoms in the Dow during the second half of 1997 and the start of 1998. The idea is to shift the arcs until their lows coincide with a number of reaction lows on the price chart. Fig. Beginning with the major bottom in 1981, the cycle finder Aries revealed that bonds have shown a tendency to form important bottoms every 75 months, 6.25 years. These numbers may shift with time, but still provide useful trading information. Fig. Applied to this daily chart, the cycle Aries showed a tendency for bond prices to bottom every 55 trading days during this time span. See arrows. Seasonal cycles. The seasonal cycle refers to the tendency for markets to move in a given direction at certain times of the year. Fig. Soybeans usually peak in May and bottom in October. Fig. Copper usually bottoms during October. Fig. Soybeans usually peak in May and bottom in October. Fig. Copper usually bottoms during October and February, but peaks during the April-May period. Fig. Copper usually bottoms during October and February, but peaks during the April-May period. Fig. Crude oil prices peak during October and turn up during March. Stock market cycles. Did you know that the strongest 3-month span for the stock market is November through January? February is then weaker, but is followed by a strong March and April. After a soft June, the market turns strong during July, the start of the traditional summer rally. The weakest month of the year is September. The strongest month is December, ending with the well-known Santa Claus rally just after Christmas. Cycle reading and software. The Alex Cycle Forecaster and Walt Bressert Cycle Trader are both available as add-on options to run with charting software provided by Omega Research.